All right, everybody, we're here with Justin from Dynamo Capital for the February 2026 update. We've got Brian here as well. So we'll just jump right in on this. Um, let's get over here. As usual, our normal disclaimer, this is not an offer to invest. This is just informational purposes, um, all that fun stuff. No forward-looking statements. And then, of course, you can find more information in our data room at bycapitalgroup.com/data room. With tons of great information. We're also uploading these monthly recordings in there so you can go back and follow trends as the year progresses. And then, of course, we are still accepting new capital. So if you're an existing investor, you're welcome to increase your position. If you're a new investor that's been thinking about it, reach out anytime. Give us a call. You can do a soft commit and get things going. Soft commit is not legally binding. So, all right. Without further ado, we'll jump right in. So, hand it over to you, Justin.
Yeah. So February, as we expected, was a slower month for us. We've expected Q1 to be slow. Just for anybody that's been in the real estate or mortgage world for any period of time, always knows that Q1 is usually a bit of a slower season, as everybody usually takes some time to get out of the holiday slump and get rocking and rolling. So February was slower, as we would imagine. Our revenue and profitability stayed roughly flat from the month prior due to our slight increase in our portfolio size over that period. So our interest revenue carried quite a bit during the month. But really what we've been focused on throughout all of Q1 is, really pushing hard the new capital market strategies, new lines of credit that we're getting put in place, and then also building out the sales channel, which is something that is a big focus for us throughout 2026, is really understanding how we want to build out our sales as we're expanding into new geographies, and ultimately, different sales channels as well. And so I mentioned here in our commentary, we've started building out a TPO channel, which is a third-party originator, right? Essentially, there's two different sides to the mortgage business, at least the way that we're seeing it. There's your retail side, which is direct to customer, and then we have the TPO side, which is B2B essentially, right? So we're the target client there is mortgage brokers who have a base of clientele that want to do their DSCR loans or RTL loans, and we're creating a channel that is specifically focused around targeting that customer as well, right? So we're not we're not trading one for the other. We're adding and supplementing through a different customer base. And so we've brought in a gentleman by the name of Dustin, who this is all that he does, is he helps to create TPO channels. He's done it in a couple different places, and he's going to do it the Dynamo way for us here, and start to build that channel out with a couple of good account executives internally that already have good books of business that can allow us to help explore and tiptoe into that market, into that world, and still feel like we are maintaining underwriting discipline and all of that good stuff, of course, which is ultimately the most important thing for us. So we'll keep everybody abreast, obviously, as we continue exploring that over the coming months. So we'll keep everybody abreast of how that's looking and how that's feeling, both from a volume perspective and from a performance perspective. So
is it active now, or is it just?
Yep.
Okay.
Yeah, just over the last couple of weeks. Yeah, so we really got this. We've been interviewing with Dustin for the last call it 2 months. We finally brought him on board here at the tail end of February. So this conversation's been in place for this conversation around the TPO channel has been in place for the last 6 months. Me and Matt have been kicking the tires on how this looks, how we feel about it, what we think about it. Do we need to have different operational rails? Do we need to keep things going in the same direction? How do we, ensure, we have a good customer experience? We were brokers before, right? So this is the channel that we would have gone through. And so when we're thinking about it from the sales perspective, from the broker side of things, right? It's we don't want to be everything for everybody, right? But how do we provide enough to the brokers to be able to capture market share there? And how do we also ensure that we're not the third resort, right, or the last resort that these brokers go to, right? We want to be the first call. We want to be the first place people go to get their paper stuff, the stuff that's going to work very, very well because they know that we can execute. And ultimately, position ourselves in the best way to have the best customer experience for the broker, the best customer experience for the client and the borrower, and ultimately have the best performing loans we can, regardless of the channel. So it's something that we've been really thinking a lot about over the last couple of quarters now, and really the big key was finding the right person who could lead that charge in Dustin, because we need somebody who lives and breathes Dynamo, who understands what we're thinking about, understands how we think about this particular channel and just sales in general, and then have somebody ultimately who's passionate about the TPO channel as a whole that can really lead that charge for us that we feel comfortable with. So all that stuff kind of came together over the last couple of weeks, or over the last couple of months, and we finally put it in action over the last couple of weeks now.
Gotcha. And so this is for both RTL and DSCR type products?
Yep, it's for both. It'll be much heavier on the DSCR side than RTL. RTL is going to be very geographically focused, as it always is, right? If we're holding those loans on our balance sheet, we really want to make sure that we understand the markets that we're in, and that doesn't change regardless of where the loan comes from. And so we've really locked down the geography on where we're comfortable lending for that particular market. So as we get more familiar with more markets, we'll start to open that up slowly over time. But right now our focus is just loaning in the areas we know. And if RTL loans happen to come into those markets, then we'll look at them. But if not, then that's okay. We'll just keep loaning on the DSCR side.
So how does that work on an individual loan pricing scenario now that you have another layer of comp?
Yeah, so it's something we have to keep in mind as well, right? And I think pairing, it actually just worked out well. We're closing our 2 of our new credit facilities this week, which is increasing our net interest margin quite tremendously. And so we have a little bit of wiggle room there. And so the way that we structure the pricing with the brokers, we know the loans are going to look and taste a little bit different. They're typically going to be longer terms, but we're still going to make basically roughly the same all-in yield. We're just going to slice it up a little bit differently. On the DSCR side of things, we are going to we trimmed the margin down slightly because we wanted to be at or slightly below market in terms of pricing. Right, as a new entrant to the market, you got to get people excited, right, to come to you. They have to have a reason to go out of the norm, and so we price ourselves competitively enough to gain business that way through sheer pricing. We're not the cheapest price by any stretch of the imagination, but we're certainly punching above our weight in terms of the pricing contemporaries that we have today. And we've done a lot of research on that. So we thin the margin down slightly compared to the retail sector, but our cost to acquire customers going way down, and we'll make that up via volume. And ultimately, as we continue to grow and scale, we can gain margin just through volume with our counterparties, and we can continue to increase the yield over time.
Gotcha. So then does the broker just add his fee on the front end then? It's separate from you guys almost?
Exactly. Yep. So they just charge a broker fee, right, of whatever they choose to charge, right? Usually it's going to be between 50 basis points and 200 basis points, depending on the broker and the loan size and so on and so forth. Okay. So that's mostly irrelevant to us on the DSCR side. On the RTL side, it's a little bit more defined. They can take either a point or a point and a half, and that'll determine what the rate is that we put on the backside.
Okay.
And Justin, how long are you guys holding those DSCR loans? Those are pretty fast now, right?
About 30 days. Yeah.
30 days. Okay.
Yeah. On average.
I know you guys were talking about trying to speed that channel up. Is that still something you guys are
on the trading side or on the actual volume of the loans?
No, on the trading side. I know you guys talked about like a wet line of credit at one point. I remember.
So that's actually one of the lines of credit we signed yesterday. So that'll be a wet funding line. And the way that'll work is, right, as opposed to us funding the loans out of our bank account and then getting reimbursed between 10 and 15 days later, we will be funding those loans directly off of the line of credit, meaning the funds actually never touch our bank account. And so we don't necessarily feel the actual funding of the loan in terms of our cash position. So it'll allow us to scale more effectively and much more grow that channel much more efficiently without having to worry about, it's fine enough when we're doing, a couple $1 million a month here and there, right? We can float that cash for a period of time because we maintain that type of liquidity. But if we're wanting to push to 20, 30, $40 million a month, which is our target by the end of this year, that's a lot of cash drag for a long period of time. And so having having a wet funding line is going to allow us to scale much more effectively.
Right. And then, so you guys were talking about shortening that period too, right? Between
On the trading side.
Yeah, on the trading side,
Yeah.
right? So you're paying
Yeah,
less interest.
Yeah. So our goal is obviously to drive that trading cycle down as much as possible. I think there's a couple different paths on the trading side, right? And I could probably do a whole hour spiel on this type of thing because it gets very complex very quickly. There's a lot of different paths you can go down. I think that, based off the current setup we have, I think the fastest we could probably, the fastest that we could do or have our trading cycle. Excuse me, man, my goodness. I'm drinking too much. I mean, I'm 3 or 4 of these deep today.
Oh my gosh, what is that? A monster?
I'm washing it down with a monster. Sugar free, to be clear.
Crazy.
Free. And then of course the coffee's over here. So apologies for the
wow.
It's
a lot.
We gotta stay hydrated,
Yeah.
Anyways, in terms of our current setup, right? There's I think the lowest we could probably drive that trading cycle down to is probably close to 20 days. Realistically.
Okay.
So I think we could probably shave 10 days worth, which really, it just allows us to turn that capital quicker, right? I don't think our interest cost is going to go down, but the overall volume that we can do is going to increase by, 30% year over year. But there's a couple different strategies that allow us to, that would be potentially more effective, right? You could probably drive it down to 10, 15 days, but those come with slightly different parameters around them. They're called forward flow commitments, or at some point you start selling a reliance letter, but you're aggregating loans at that point. And like I said, we can dive much deeper into that rabbit hole. I'm sure you guys would be very interested in that, but we can talk ad nauseum on that, maybe a separate video. But.
For sure.
Great.
All right, let's see what's next here. Okay, so you run through the top line figures.
Yeah. So I'll keep it pretty brief. I know everybody can read here. So about 1.1 in fund revenue, approximately. A big chunk of that being in interest revenue. Of course, we had, like I said, a pretty light origination month, and then we ended up with $840,000 of fund profit. Fund expenses allocated to January, roughly stable from January. We will start seeing maybe a small uptick in third-party service providers as we're entering tax season. We're starting to make deposits and payments for tax forms and all of that good stuff. So we do expect to see that increase slightly over time. But with the way that our pipeline is looking, we think that we're forecasting our fund revenue to increase pretty drastically over the next couple of months. Obviously, no guarantees, no. Nothing there, of course, but the way that our forecasts are trending, we expect that to be a pretty negligible increase in third-party service providers compared to the profitability.
Gotcha. Well, speaking of taxes, for our investors that did get their money in for December 1 earnings, they will be receiving a K1, correct, for that 1 month of earnings?
You guys will. So VY will get a K1 from us,
and then we'll
I expect it'll take you guys probably 30 to 45 days, maybe a little bit trimmer than that, to turn your guys' K1 around. But we still expect to be able to get those out by deadline, which I guess is tomorrow or Monday, depending on how they look at it. I don't actually know, but the 15th. So
okay, so that's great. That's good to know. So for our investors that were in on December 1, VY will be getting the combined K1, and then we'll be sending that off to TribeVest, and they'll do that individually.
And they'll issue the K1s,
Yeah,
so,
for each individual investor. So do plan on filing that extension because
I would certainly recommend it.
The wire. It's unfortunate, it's just for 1 month, but is what it is.
Yeah.
So, okay. All right.
Yeah.
And then we had, we talked about it in the KPI, so let me know when you want to talk about that.
Yeah, we can slide that in after this if you'd like. But in terms of our loan origination, like I said, pretty light month, about $5 million in total loan volume. Just for context, we've already funded over $5 million this month. We've got a big month, big back half of this month already. So a lot of stuff in February ended up pushing out into March for a variety of different reasons, which was just fine for us. It wasn't, we had pretty good interest revenue coming in, and so we weren't overly concerned about that. And we started to drill down a little bit less into what are the monthly figures, right? And start more so worrying about what are the quarterly overall numbers and what are the semi-annual and annual targets that we can continue to hit. The monthly figures will continue to even out over time. As we continue to grow and scale. So this is just an effect of our growth and scale in the sales department and a slow Q1.
Got you. And of the 18 loans, that's a combination of DSCR and RTL, correct?
That's correct. Yep. So
Okay.
it was a little bit more skewed towards the DSCR, if I recall correctly.
Okay. Gotcha. All right. So you're ready for me to jump to that KPI screen? I'll have to switch the share here. Okay. Okay, let me get over here to Excel. There we go.
All right. I will. I'll guide you through this here. So this is our loan KPIs. This is what we look at in our portfolio to measure kind of the health and how everything is trending compared to what's in servicing and what's been paid off. We do track the projections in here, but the projections are just that. They're projections. They may fail in underwriting. They may not fund. They may move to a different opportunity. We may close a loan. We don't know, so we don't look too heavily at that. But it is good for us to kind of get an idea of what the trend is like in terms of loan volume and types of loans and whatnot. So, but what's relevant to us is what's in servicing today, and how is it performing today, and how does that compare to what we've had in the pipeline or in the servicing portfolio over time. So we've got 108 loans in servicing for about $90 million. About a 75, 78, 22 split between what we call, fix and flip or bridge compared to ground up construction. So a little bit lighter on the ground up construction, although you can see in the projections, we're seeing a big uptick in ground up construction requests as some of our contemporaries are just becoming a little bit more difficult to work with. We're seeing a lot of clients leave their current lenders and coming to work with us on their construction projects. So I expect that to increase slightly over time. You could see as well, on the total loan portfolio, we got about $90 million in loans today on the books. We've had $51 million of loans that's paid off. That is not of the $90 million. That is a combined figure. So of the $140 million of RTL that we've done, $51 million of that has paid off and moved on to another project. So we've got $63 million of UPB as of today, which is utilized principal balance. It's the amount of cash that's actually been sent out the door that we have sitting out. That is also in conjunction with the holdback. That's slightly under where your mouse is. We've got about $18 million in the holdback that's remaining on those loans as well. Those are the unutilized rehab funds or construction funds that are sitting in reserve for those loans to be spent. And then there is a delta there, which Chris pointed out to me yesterday, which is a combination of interest reserves and other holdbacks that we have that are not necessarily reserved for construction. So if anybody does the math of 63 plus 18, it does not equal 90. The delta there is, like I said, the interest reserves and a few other holdbacks that we maintain, whether it's deferred origination fees or anything to that effect that is not accounted for in the UPB on day one. So we're looking at the portfolio today as well in terms of the makeup of the fees and cost structure. You'll notice there's been a slight decrease in the origination fee and an increase in the weighted average interest rate. That's been an interesting trend that we're continuing to keep an eye on over time. And we'll continue to keep a pretty hard look at how that's trending. And ultimately for us, right, it doesn't really matter too much if it's fee or interest rate for the most part. It's all treated roughly the same from an accounting perspective. It's overall, can we get to the yield that we want with the cost structure, right? If we could do loans at 1 and 9 and still make the same yield, we would, right? We have no reason to,
Right.
we don't want to overcharge the customer just for the sake of doing that. We want to be in market, and right now we're still in market. We're competing very effectively with, our competitors and winning loan business, even though we're not pricing, the sharpest across the stack.
So those loans are just basically, they're yielding the same. It's just either on the front loaded or back loaded with the interest rate.
Exactly.
Okay. And that's just the market's just sort of, whether it's fix
Market
and flippers.
dictates. Yeah.
Yeah. Okay.
Some people are, some people want, they want to come less out of pocket for whatever reason. I mean, I've never heard of a real estate investor that wants to come more out of pocket, of course.
Right.
But, there's some folks that are perfectly happy to pay 3 and 12. And there's some folks that want to pay, they want to be at 0 and 15, right? Or something to that
Right.
effect, right? So we have got a little yield calculator that we utilize to kind of create a pricing structure that makes sense for our sales guys to be able to be dynamic and shift that up or down or sideways, however they see fit, right? We don't want clients to be, we don't want our borrowers to go to a competitor just because we're inflexible with our rate structure or our fee structure.
Right.
Of our salespeople the ability to be dynamic there, and that's why you'll see a variety of different rate and fee structures in our portfolio today. We've got some folks that pay just a flat fee at closing, right? They'll pay all points and no rate.
Interesting.
And we've got some folks that pay, want to pay no points and all rates. And so we've got it all over the spectrum. And we're okay with that because at the end of the day, right, the way that we structure the fund allows us to be dynamic enough in that capacity. If the manager kept the origination fees like a lot of our contemporaries do, then their hands are kind of tied to an extent. Whereas, with the way we have it structured where we're sharing the origination fees with the fund, it allows us to be dynamic there. And ultimately, we feel like gain more business because we could be flexible and fluid with clients.
Right.
Gotcha.
And this is where we, on the loan status side of things, this is where we look at the duration of our loans and we keep track of, how the bulk of our portfolio is performing based off of the different loan types and loan values. The in servicing column is not necessarily the most relevant here. We're mostly looking at the paid off column because the loans in servicing are still in servicing, and so those numbers will adjust over time. But the paid off is ultimately, right, how has the book performed compared to the maturity dates that they have in place, right? So we track what's the agreement duration, right? So this is what we've actually written the loan for. It's not always a clean 180 days. If it's a 6-month loan, it's going to be usually 180 days plus however many days into the previous month they closed, right? So when we close a loan, it's always the maturity date's always the first of the month following, right, that period. So if you close a loan in April 5th of 2026, and it's a 12-month loan, your maturity date is going to be May 1st of 2027. And so that 15 or 25-day gap is going to be added on to the agreement duration, right? Now, they still pay interest for that. It's not free. But that's why it's not a clean, 365 days or 180 days in some of these categories. So, but everything, all of our loans are typically paying off within duration. The rehab loans, an average duration of 6.6 months versus 6.1 months of actually getting paid off. Bridge loan 6.9 to 6.1, and ground up construction 8.9 to 11.9. So everything's paying off within the maturity period, which is what we're looking for, obviously. As we continue to expand into new geographies, we expect to see probably our average duration maybe kick up a little bit, but we don't think it'll be too tremendously much. We really do a good job of on the sales front, on the structuring side, writing the loans for what the time frame of the project actually is, right? If we know somebody's going to take 9 months to do a deal, we're not going to write them for 6 months. We're going to write them for probably 9 with a 3-month extension option or something to that effect, right? We don't want to put ourselves in a position where we're forcing extensions constantly, because at that point, we may as well just write the loans for a longer period of time, right? It's going to burn the customer, even though we can monetize those extensions, right? That's not the primary source of how we drive revenue. That's just a little cherry on top, I suppose, if the deal spills over. But if the deal does spill over, then that's something we need to look at, and we need to understand why that's happening, right? We're either not structuring the deals effectively, or the deals are not going as smoothly as we expect, and we need to understand why that is. So
right, and you guys have a lot of repeat customers too, so you don't want to just burn them in late
we don't need
fees
to
and
nickel
stuff.
and dime people. That's
Right.
not interesting to us. So last thing we'll touch on, weighted average credit score, and our leverages here. So weighted average credit score of 720, right? We like that. That's pretty healthy credit quality. We like that. It's slightly down compared to our paid off metrics, but it's actually been increasing slightly over the last several months. It was in the 750 712 to 715 range over the last several months that we've been looking at it, but it's ticked up to 720 over the last month or two. So, and then our leverages here. You'll see most of our leverages have fallen, with the exception of loan to assets value. Still very healthy numbers that we're very happy with. Right, 75% loan to assets value. That's day one. Right, we get a third-party valuation. What is our loan to the as-is appraised value right as it sits, right when we fund it? That number on average is 75%, which makes us pretty comfortable knowing we have a little bit of an equity buffer built into those deals. Average loan to cost of 86%. So our average borrower is coming in with 13% skin into those deals. Of course, we average, we advertise 100% loan to cost. So you'll see our our rehab loans are screaming up into the low to mid 90s there. We're still comfortable with that, right? We know that on the flipping side of things, it's become almost market to be able to have 100% LTC product. A lot of our contemporaries are starting to come out with it. But ground up construction and bridge loans are generally going to be a little bit weighted lower. A lot of times ground up construction, the builders already own the dirt, and so they already have a lot of built-in equity. And then bridge loans as well, same thing. A lot of times those are clients that are coming to us with an asset that needs to transition. And so they either put a lot of money down, or they're coming out of what we've been seeing a lot too is builders who are needing to exit their construction loans, and they're coming to us with property that's already built. And we're just doing a rate and term refinance for them to give them a little bit more time to sell the assets. So that's how we think about those. And weighted average loan to value, of course, this is the biggest one that we look at. What's the LTV of our portfolio? If we're going to take things back today and we finish the projects, what does that look like? We've got basically a 35%, 34% buffer there in terms of equity to be able to absorb any market inefficiencies before we start, even thinking about getting to a principal state. So.
All right. Well, this is a great form. I had not seen this before.
Yeah, this was on the fly yesterday.
Oh, was it really?
Yeah,
yeah.
I don't know if we have that slide, but like the weighted average loan to value, that's been trending down pretty significantly, right?
Yeah, it has. Yeah, so we were in the 70s, the low 70s for a period of time, and ultimately, as our portfolio has grown, we knew it was going to stabilize, right, at a period of time when you only have 30 or 40 loans in the portfolio, right? Those averages get skewed very quickly depending on what's more heavily weighted in the portfolio. But as we're in a $90 million portfolio as of the time of that screenshot. We'll be well north of 100 million. We expect by the end of this month. Those averages start to stabilize at what are the actual loans and what's the actual stabilized LTV of the portfolio. We feel pretty comfortable and confident it's going to stay roughly in that call it 65 to 68% bucket pretty consistently moving forward.
What I know Matt's not here to talk about his love of Boston market today, but can you talk about the expansion plans into the Northeast?
Yeah, so we've hired a couple different loan officers recently, one of which is in Tulsa, Oklahoma. Great market, about 2 hours south of Wichita. Get a great LO who was introduced to us by some of our investors, actually. So that's been great. We also hired a great loan officer up in Boston, Massachusetts, which was not necessarily in our plans, but the way that we think about growing in our sales organization, it's very similar to the expansion into Denver. It was never necessarily our immediate intention, but we found a really great loan officer that we really felt like understood what we were looking for and was ultimately a protector of the fund. And he's based up in Boston. He's a real estate investor in that market. It's also a market that's pretty well insulated from private lending activity for the most part.
Interesting.
There's not a lot of players in the market. I know Matt likes to joke that it's run by the mob up there, but I won't comment on that front.
Let's hope not.
but I hope not either. But from what we've understood, there's a lot of it's run by a lot of mom and pop lenders up there. There's one or two institutional type players, one of which we compete with pretty heavily in Denver, and we do fairly well against. And so it felt like a pretty natural, okay, we can understand like the players in this market, how to compete against these people. It's a market that's been operating fairly stably, and we have a loan officer up there that really understands the dynamics of the market, owns real estate in that market, and can ultimately help us expand into it slowly over time.
What do you think the average loan size will be out there on the East Coast?
Probably in the 800s, I would guess. It'll probably be pretty similar to what we're doing in Denver, from what I've seen.
Okay.
What's I don't know if you got the numbers, the breakdown of the portfolio, what markets we're in?
Yes, I did this exercise yesterday.
You did. I probably have the numbers right here if you don't have them. Just want to make sure we shared them with everybody.
Yeah. Let me see if I still have that spreadsheet up. If you had them written down from yesterday, I will co-sign your numbers.
There we go. Okay, so Kansas and Missouri 41%.
Yep.
Colorado at 27%.
Yep.
Texas at 16.5%, and then other markets at 15%. And that's by volume.
Yes.
So
yep. That all sounds correct. So that's the makeup of the portfolio today. I suspect that Kansas and Missouri will probably trim down a little bit, just in terms of sheer volume, right? Colorado is a bigger market. Oklahoma is a bigger market. Massachusetts is a bigger market. Texas is a bigger market. We just expect more loan volume to come from them. Now, in terms of unit count, I suspect that I did do that exercise for units, and it was much more heavily weighted toward Kansas. We do, I think the actual unit count is somewhere in the 65-70% range for Kansas. And so I don't suspect that number will fall too dramatically. But as we expand into new markets, of course, we expected those geographic dispersion to be a little bit more spread out amongst some of our key states there.
Great. And then can you touch on the risk modeling? I thought that was really cool when we heard about that. You guys are doing.
So our managing director of capital markets, his name is Ross. Before he was in the private lending sector, he was he worked at the Federal Reserve, and he was building default models for them. And so something that he's been working on recently for us is building out our own internal default model, where essentially we have we tell this model, okay, we have X number of variables for an RTL loan, right? So maybe it's the FICO score, it's the geography, it's the loan to cost, it's the loan to value, it's the size of the holdback, it's the experience of the borrower, right? We have these 10 or 15 different variables that we give it. And each of those variables will have some sub items, right? So under FICO score, maybe it's, over 750, it's over 720, it's over 680, 600, right? We tier it out under each of these different variables, and we assign a score to each of these different sub buckets. So maybe we say a 600 credit score is worth a 2 out of 10, 750 is worth an 8 out of 10, and everywhere in between. And then we assign weights to all of these variables, all of these 10 to 15 variables as well, right? So maybe we think FICO score is the most important thing for determining whether a loan is going to perform or not, and we give it a 25% weight in its scoring model. And so what we ultimately do is we give the default model all of these different variables or all these different inputs based off of the different variables that we want to track, and it will spit out a score, right, a 1 to 10 score. Basically is telling you, hey, based off of all the inputs that you've already given to me and based off of all the data you've told me, this is how likely this loan is to perform compared to another loan. So, maybe a loan with a 780 FICO and a 50% loan to cost and so on and so forth, maybe is much more likely to perform compared to a loan with a 600 credit score and 100% loan to cost. And so we can start looking at, especially as we're expanding to new geographies, we can objectively look and say, okay, we've had, 250 loans that look this way. How do these loans all perform? And how likely is this loan to perform based off of these variables? And so as these models get better, the more data you feed into them. And so we've got several hundred loans that we've done since Dynamo's been around. And so we could start feeding it all that data and telling it, right, these loans performed and these loans didn't, and adjust the scoring based off of that, right? We don't want a loan that we know defaulted having a high score, right? That doesn't make any sense. Now, it also doesn't necessarily mean that a loan with a high score won't default, but we need to tweak those variables and understand, how can we refine this model in a way that allows us to really understand the risk, and then ultimately we could start to drill down into even, all right, if we have a loan with these parameters in this geography, it's more likely to perform than a loan with the same parameters and maybe a different geography, right? What works in Wichita doesn't necessarily work in Atlanta, Georgia, doesn't necessarily work in Boulder, doesn't necessarily work in Dallas, right? Now, the general bones may work, right, but maybe some specific variables, right, will perform better or worse in certain markets. And so that's something that we're starting to work towards and understand, right? What's the right data that we could feed into this thing, and ultimately have it be something that our underwriting team utilizes, kind of a third party check. Third party, I mean, it's built by us, but it's an algorithm, obviously. That can help us, right, determine whether or not a loan needs a secondary review, right? So maybe loans over an 8 can fly through the system. Maybe loans that are, if they're under 6, they need a secondary review or a credit committee approval, and if they're between 6 and 8, they need a secondary underwrite from an underwriting manager or something to that effect, right? So we're still working out how exactly we want to implement that system into our underwriting process, and it's not something that it's going to be ultimately decisioning loans and telling us, yes, we're doing this loan, or no, we're not doing this loan. But at least it's a third party way for us to verify, right? Okay, based off all the data we have, how likely is this loan to do well? And how do we want to think about this loan, right? If it's maybe scores slightly under, what we would deem to be a healthy number.
Gotcha. Okay. And you guys are still at a pretty low default rate, right? What's the portfolio sitting at?
Yeah. So our default rate right now is, I believe it's sub 3%. Our DQ rate's almost 0 as of today.
What's delinquencies like? What, 30 days late, or is that
30? Yeah, anything that's anything that is 30 plus days delinquent and less than 90 days delinquent is generally treated as just DQ.
Yeah.
Right now we have a few loans that are in default, which is 90 plus days, which usually means they're heading towards foreclosure or some sort of workout solution. So we've only got a handful, nothing new since the last couple of times that we've had. Well, I guess this is our second, but since over the last several months, we haven't had any new defaults. We've got our servicing team has gotten a lot better with just through sheer reps and the amount of support systems we've put in place, where they're able to mitigate these situations pretty early on and get ahead of whatever's happening.
Great.
All right. We already talked about the LTV. I think we're good there.
Yep.
So trending in the right direction. I guess it's maybe what you're thinking in the coming.
Yeah. So, as we mentioned, we expected Q1 loan volume to be a little bit depressed compared to previous quarters, but we anticipate that March will be a bigger month in terms of origination volume, and ultimately, steadily grow, into the spring buying season and the summer frenzy. So we think it'll be pretty healthy market, and we look forward to ultimately taking advantage of the opportunity of and growing in our sales organization to capture more market share throughout 2026.
Okay. All right. So return metrics for VY Dynamo investors. So for the month for Class B, that was 1.62% or annualized at 19.44. And if you're a Class A, meaning you're under that 250 mark, that would be 1.44 or 17.2.8% annualized. So still exceeding the target. So we'll take that every day.
Great.
I'm pretty happy about that. So yeah, if you want to add to your position or jump in, if you've been on the sidelines, let us know. And as long as the money gets in by month end, we can get that over to Dynamo so they can put that to work. Let's see. I think that's it. Yeah. I think, Brian and I were talking about it. We haven't even brought it up to you yet, but I think we might be ready to do a live one of these maybe next week. So we can get some investors in here asking real-time questions. I think that would be pretty beneficial.
Yeah, absolutely.
So
happy to do so.
I think we finally caught up on the tech.
Hey, it's tech is beautiful when it works, but it is the most frustrating thing in the world when it doesn't.
Absolutely, yes. The whole tech stack is it's a lot.
No, I completely understand. That's why we got 4 full-time IT people that all they do is build is dev and all that stuff. And unless it's Excel, I'm usually not I'm not the techiest guy in the world.
Fair.
But I can hold my weight in Excel, and that's about it.
Perfect. All right. Well, thanks again for your time.
Absolutely.
Yeah, thanks, Justin.
All right. Thanks. See you guys next time.